Hi, everyone. Welcome back to the channel. This is Lupe Garcia.
And Selena Sedesetis.
This is episode number 4 of the Whitley Penn Major Fundcast podcast. We have a great episode today. We have 2 special guests, Doug Janowski of CBiz and Carlene Patterson of Alliant. Doug, please provide an introduction and background for our listeners.
Sure. Thank you, Lupe. Thank you, Selena. Hello, Carlene. Thank you guys so much for having us. So I am the Director of Business Development for CBiz Valuation Group. So we are a national valuation and appraisal team. And then specific to the folks and the topic of today, we work with public entities across the country, specifically as well as I say public entities across the country, as well as brokers, carriers, and underwriters. We kind of work with all the various parties to help them to appraise their buildings and their property for the purposes of underwriting and insurance. So we work with very large entities, cities, school districts, universities, in the private sector, a lot of hospital systems, manufacturing, because there's a large volume of things to be appraised, and not everyone has a great handle on what all that is for underwriting purposes. So that's really our goal, is to work with those folks.
And I am Carlene Patterson. I'm the National Public Entity and Higher Education Practice Leader for Alliant Insurance Services. And I'm based in Dallas, Texas. And Alliant works with all different industries, but I work in the public entity group, specializing in working with states, pools, cities, counties, and any special districts. And then also the higher education and K through 12 schools. And I really like working with public entities. Doug and I have had several conversations about this. They're just great to work with because there's a lot of collaboration that goes on between the risk managers, the finance officers, and there's a lot of sharing. Whereas when you work with some of the private companies, there's not as much sharing between the different similar roles within the different companies.
Okay, well, the topic of the day is risk management and insurance. And, what risks do you see that public entities are facing today?
Well, there are several different main risks. We have the real traditional ones that everyone thinks of. Their property, liability, whether it's auto or general liability, public officials, workers' comp, aircraft, drones. Those are fairly typical traditional risks, but there's also a lot of emerging and changing risks. Cyber has been emerging, and it changes every single day. There's a lot of challenges around police professional liability, the law enforcement, legal, diversity and inclusion within the public sector, and then also Alliant as a firm, and making sure that we're meeting diversity and inclusion goals, or working with smaller companies to help our clients meet their D&I goals as well.
Yeah, and just to add to that, Carlene, I mean, obviously that was a very comprehensive list, so thank you. But yeah, I think you can turn on the TV and everyone knows the risks everyone's facing right now, right? I mean, everything in 2020 has been a risk, and I don't know that anyone has been as affected as a group. I mean, maybe hospitality and retail and restaurants, obviously, but public entities, if you think through what school districts, universities, cities, municipalities, I mean, that is really everything we're seeing with the pandemic, the COVID, the social disruptions that are happening, the civil unrest, protests, all of this is something they're all having to deal with. So it's really, I don't want to say it's a horrible term, but like sort of the perfect storm, right? That these guys have had to take this as an entity, and they're battling on every front to make sure they're addressing all of these concerns at one time. So it's really, I don't know that I've ever lived in a world where risk managers were as important to an organization as they've ever been right now. I mean, they sit at the right hand of the top administration, the top CEOs. I mean, they are battling, all the what if scenarios are coming to fruition at one time. And then you throw on top of that wildfires, tornadoes, the earliest and strongest hurricane season we've ever seen, the earliest wildfire season we've ever seen. It's just, I don't want to pour on everyone, thinks about 2020, but it's been a very, risk management year. So these people are doing their best, and to your point, Carlene, my dad worked for the city. I grew up working with public entities my whole life, and they're good people just trying to get through 2020 like the rest of us. So, sorry.
Right. Yeah, and public entities have unique challenges in that, one, they were always working in their offices, always available to the public and the folks who work in their, work and live in their different municipalities or what have you. And then they also have the challenges of having to provide particular services, whether it's the public safety services and, making sure that everything is continuing on. While on the other hand, they're dealing with the challenges of lower revenues because, so much of their tax base is, their, whether it's residential taxes or whether it's taxes from commercial, and that's going down. So now they're going to have to try and figure out, how do I provide the services that are expected while having really decreased revenues? And you can't just say, well, we'll lay off people or, because they're essential services. So it's going to be a unique challenge going into 2021 for sure. So I want to backstep a little bit and focus today on property. Property is one of the areas that we really can't control very much. From a workers' comp or liability standpoint, risk managers can implement things, whether it's training or create conditions that will make people safer. And property is something that you really can't control, like Doug mentioned, hail, convective storms, tornadoes, wildfires. Those are things that are really out of our control, but it's really impacting budgets and it's impacting the amount of premium that public entities are paying in the property market. But really to look back at why we're having such difficulties, in addition to the actual exposures like the tornadoes, is also looking at it from a financial standpoint and an investment standpoint. So what carriers look at is what's called a combined ratio. And that basically means for every dollar of premium they collect, how much are they paying out in claims? And right now, in the past 20 years, there's only been 3 years where, in 3 consecutive years, where they actually had a positive combined ratio. So right now, pretty much for every dollar they collect in premium, they're paying out almost $1 in claims. And so that's not sustainable. As the carriers are publicly traded companies, they have boards to respond to, they want to stay financially viable to be able to pay claims into the future. So that's really driving it. In the 14 consecutive quarters, starting in the fourth quarter of 2017, rates for property had been going down, but losses had been going up. 17, 18, 19 are some of the worst property years. So you've got declining rates and then increasing in claims. And so now the market's almost trying to correct itself by increasing rates in order to collect more in premium. And, so major property losses, we have hurricanes and tornado activity that they're significantly exceeding the averages. In 2019 and 2020, we've had more named windstorms than the last 20-year average. Usually we average anywhere around 12 to 14 named windstorms. We're already up into we might have to start using Roman numerals this year because of the number of tropical events that are occurring in the Atlantic Ocean. So that's really what's been driving it. We've had 3 disastrous wildfire seasons. And then, like I mentioned and Doug mentioned, convective storms, which are, tornadoes and the resulting hail damage. Those are increasing. Dallas area had one last year where it's almost $2 billion in losses in the fourth quarter of 2019. Tennessee had tornadoes early in March, and they expect there was over 15,000 insurance claims filed from the tornadoes in March of 2020, and they've caused over $1 billion in damage. So in the last few years, in 2019, there was 14 weather-related events that exceeded $1 billion each. And when you put that together with the other losses, it's just a crazy insurance market, and the claims are much higher. When I complained about my own personal homeowner's insurance, I kind of find that ironic since I'm a broker, but my agent said, think of it, 15 years ago, if a tornado came through, there was maybe 10 houses. Now, when a tornado comes through, the hail damage is 50 houses, so 50 new roofs. And so there's things that are just out of control. And we just know in Texas, we're going to get a new roof every 3 to 4 years. So
Yeah,
that really is what's driving the property and driving what's called the hardening market, where the rates are going up and there's not a lot that you can do about what's happening.
yeah, Carly, sorry.
Oh yeah. Oh no, go ahead.
I was gonna say, if I could just add, so, in my own personal life, so I don't know that any of you would have ever known this, but I was actually studying in college to be an actuary. So hence the reason I got a math and a finance degree. And then I found out as an actuary, you had to take 20 exams over the period of 10 years, and I gave up. However, I remember, 25, 30 years ago, okay, I'm going to date myself, 30 years ago, catastrophic modeling was like the new thing. Like that was just a brand new concept in the actuarial world. And now 30 years later, that's the standard. In the clients we work with, Carlene, ourselves, in this entity space, you want to be able to share this information, but I'll give you an example. Earlier this summer, we were getting reports of the warming oceans, and this was going to be the worst hurricane season, which creates flooding, which creates tornadoes, which creates wind and hail. We were getting reports of dryness on the West Coast. And so you get these, but you don't want to put them on LinkedIn. I mean, people are dealing with the pandemic, they're dealing with shutdowns, they're dealing with their kids being home from school, they're dealing with remote work. So there's this, you have this just internal battle about wanting to let people know that these things are coming and that you've got to prepare for them. And the other thing I'll say about that is, from an actuarial standpoint, it's a formula. It's not subjective. It's not personal. It's not people. It's a formula. Thousands of brilliant people who took those 20 exams over 10 years sit around and come up with the formula that says this is what's happening in the world. And so, the byproduct of this is, I always love the quote that stress is something that affects you over which you have no control. That's literally the definition of stress. You're being affected by something that you can't control. And I know the clients and the public entities are feeling it because they're being affected by it, both personally, directly from the events themselves, but also when they have to work with their brokers and carriers, and they're seeing premium increases. But the brokers, the carriers, and the underwriters are being affected by it as well, because it's just an impersonal formula. It's data. And so at the end of the day, it's not that anyone's doing anything, it's that we're all in this together. And so one of the messages we always try to convey when we talk to our clients is, this is a team approach. We're trying to work with everybody and find whatever avenues you can to mitigate these things. And you can't change the formula. Maybe at a holistic level, you could change, building materials and things down the road. But today, what you can do is be a proactive partner to change the things you can, which are loss control, loss prevention, and data. It's a formula. The data you put in defines the answers you get out of it. So your actions, your behavior, and your partnership are the things you can control. And so that should reduce the stress to know that these things are happening. And I know, working with brokers and carriers and underwriters like Carlene and others, that they're not happy. This is not something someone wants to wake up with, that catastrophic events are happening and they've got to go to the clients they've known for 10, 20 years and bring these premiums or these things, a hardening market that comes with it, and tighter underwriting standards and higher. They want to partner. We want to help the client. So it's kind of this, again, I hate to say, it's a confluence of bad events, we kind of all knew were happening, right? But they're going to have, an impact here that we've got to work together to figure out a way to get out of. So, or at least find the best solution until we can find a better solution at a global level. So,
you make a really good point, Doug, and that's, as a broker, we're trying to differentiate our clients when we go into the insurance market. So it's the story that we put together to tell the insurance market. And, 5, 10 years ago, we could almost try and isolate our clients. So if we had one that was in the Midwest in the property market, and there had been a lot of hurricanes or maybe a major earthquake, we could isolate that client and say, look, they don't have this exposure. Their loss history is really clean. And so we would try and you could get better results because of that. Unfortunately, because of what's going on in the global insurance market, it does impact every local municipality. And we used to be able to say, well, what's happening in Japan isn't really going to impact you here. And that's no longer the case. And part of that is because the underwriting community has combined. You have insurance carriers that are combining together, which means that there's less markets to go to. You have other carriers who have changed their appetite and they don't want to write property anymore because it's not profitable or whatever it is. And so, and then you have carriers today here in the US, and they're going to London for reinsurance or going to European markets for reinsurance. And so those reinsurers are also insuring catastrophic exposures in Japan or the UK or wherever it is. And so it all trickles down to impact our clients here in the United States. And so it's very hard to compartmentalize our local clients here and keep them away from what's happening globally, because it doesn't work that way anymore. And so that's what's making it really difficult. And just like Doug said, it's having the data and and being able to communicate, not only you as a risk manager or a public entity getting the right information from your broker or your appraiser or whoever your vendors are, but turning around and giving that information to your team, whether it's upline and your managers, the CFOs, the folks you report to for budgetary purposes, but also your team, that you work with that report to you, to make sure they understand what's going on and have expectations. We're talking about what's going on in the insurance market 6-8 months before one of our clients renews. So they know what's going on and we're trying to keep them fully prepared. And so, just like Doug said, having a lot of data at your fingertips is the one thing that you can control. And the story that's being told to the insurance market is one of the things that you can control. All right, so what can you do to prepare for this market when there are so many things you can't control? I would say data, and communicate. So there you go. So that just kind of goes back to, the accuracy of your information. And, we talk about construction, occupancy, protection, and exposure, COPE information, and having all of that in a schedule of values. And so, Doug, you want to talk a little bit about what goes into the schedule?
Yeah, I mean, again, so, I tend to think at that higher level, or more, I'm a visual person. So at the end of the day, when you provide your data to a broker or carrier, they're handing it to an underwriter. An underwriter is putting it into a certain format, and that format literally plugs into the data. The more columns of information you can provide and the more accurate that data is, the better the answer. So think about, like, if you're a CPA, Lupe and Selena, imagine that. But you're doing someone's tax return and they come in with a trash bag of documents and just throw it on your desk. Right off the bat, you kind of already know this is going to be a messy tax return, right? Like you just know it's not being prepared, it's not showing. And by the way, these underwriters, with everything happening, are moving fast and furious. And so if you are able to come in and have all of your ducks in a row and you have clean data, and especially, I'll go a step past COPE, you've got secondary COPE, which is your exposure to catastrophic events. If you're in wind and flood and in seismic areas, or, especially along the Gulf Coast, it's wind, hail, and flooding. Well, what is wind and hail? It's roofs, right? So do you have a handle on what kinds of roofs? You could look at a large building, let's take a high school, and you can't just say that roof's 15 years old. It's probably had 4 additions done over the last 15 years and some portable buildings. So, you can't just say that. There could be part of the roof's 15 years old, part's 5 years old, part of it's composite. It could be it's a mixture of roofs, right? So understanding the framing, the materials, and when you get to these large public entity sizes, they can have hundreds and hundreds of buildings. So their maintenance and facilities crews go out and visit, but on a reactive basis, right? They go out to fix something after the fact. So taking a proactive measure, like getting an accurate understanding of your roofs. We implemented a new technology this year that does roof ratings. So it'll actually use AI and technology to look at the roofs and satellite imagery to let you know how you can be proactive from a loss control and a loss prevention. Those are exactly what they sound like. If you're a good steward of your public entity, you're proactively going out and trying to find what could go wrong. Do I have an accurate depiction of what I'm asking them to insure? I'm working with my broker and carrier. Do I have an accurate depiction of, have I walked all 900 buildings in the last 5 years? we'll get a statement of value, which is what you provide to your broker for these large entities. And let's take a high school again. And this is a true example. It'll have one building address and one value. We just pull it up on Google Maps before we head out, and you'll see 5 buildings. They're noting it as one building, but there's 5 buildings there that have been added on over the years. And don't forget about the scoreboard in Texas that you put in that was $500,000, and the press boxes you put in above your field if your team's good. But these things are things that people don't think about. So and it sends a message. So in the world of insurance, there's a premise called adverse selection. And adverse selection at its easiest level is the people who go and get auto insurance and want the lowest deductibles tend to be people who get into lots of car accidents, right? The people who want the lowest deductible do that because they think they're going to make lots of claims. But the people who want high deductibles feel like they're safe drivers. They feel like they have a good handle on, they bought a nice safe car. They don't plan on putting every ding in their car through an insurance provider. So the behaviors that you exhibit are the things that differentiate you from the baseline, the formula. The brokers, the underwriters are able to tell a story about your accuracy of data. And even when we're going around appraising buildings, entities will often engage us to, we have a checklist, we can look for loss control and prevention while we're walking 900 buildings and say, here's things that we saw walking while we did that you might want to look at. Here's the roof ratings, here's the materials, the ways they're attached, the geometry, the framework. And you now have an accurate discussion with your partners in the insurance, and you can sit down and come up with plans. And that in and of itself allows you, it's not going to change the formula completely. It's not going to stop wildfires and hurricanes and tornadoes, but you are being a proactive partner in the process versus allowing the formula to dictate to you the outcome. And that's what we can control. So that's where, stress is stress. I can't control those things, but I can be an active participant in the process to help mitigate what's happening. And that's where
and that's what I meant by what story do we tell the underwriting community right now? There were times in the past where you could get a 3-year deal or a 4-year rate deal. And now everyone has to market every year. And so underwriters are dealing with 10 times the submissions that they have in the past. So anything you can do to make your exposure and your schedule look better and what you're putting into it from a loss control standpoint, the better it will be. And it kind of raises, the cream rises to the top. So the better exposures are going to be at the top of the list.
And Carlene, I'll share with you because it's funny. I never like to put people in a position to feel bad. So if you're a public entity and you have all your values in a spreadsheet, don't worry. You're like everyone else. Everyone has all their values in a spreadsheet. The difference is, have you been rolling that spreadsheet forward for 20 years and just putting a plug value of 3% increase in there and calling it a day? You do that long enough, and in reality and spreadsheet no longer match. And that's, you've got a risk. You could either be much higher than what your buildings are actually really appraised at. Now you're actually overpaying for premiums. You're not actually getting what you actually have. Or you could be well under, and now you're not covering your risk. Right. So Carlene, you brought up the tornado that went through Dallas. I think any of us who lived here remember that, I don't want to, if I'm a risk manager or a CFO, I don't want to be that person. Local media loves a good story, and they want to show up on the doorstep and say, why was this elementary school underinsured for the roof that flew off, and now the kids can't go back for 3 or 4 years? I think in that scenario, regardless of what people, I think it was amazing. Mark Cuban stepped in and paid to fix the roof. So if your backup plan is Mark Cuban, great. But if you have accurate values and you're doing, sorry, I hope Mark Cuban doesn't listen to this podcast. Thank you, Mark. My wife taught at that school.
We hope he does.
What's that?
Like, we hope he does, and that means we're doing well.
Exactly.
Right.
Down in Houston, you got JJ Watt and your folks there. But this is the key: is accuracy, proactive, loss control, and the same things you would do in a residential. If you guys in your own personal lives went to an insurance carrier or broker and said, I have a house, it has a door, it's 2,000 square feet, and there may or may not be a sinkhole in the backyard. Are you going to get good underwriting terms? I mean, or if you go in and you say, I replaced the roof 3 years ago and it's composite, it's attached, it's good, and you provide accurate data, then you get more bids, which creates competitive pressure to keep rates down. We live in an efficient market. So if you have accurate data and everyone can bid on it, I mean, Carlene, you've probably seen this, but there's some cases where people's data is so inaccurate that they can't even get people to bid on the work right now because the underwriters just say, I can look at this and tell it's not been updated in 10 years or it's not been proactive.
Absolutely. Yeah. And, you know, you bring up a good point because the accurate valuations drive so many things. They drive the modeling, they drive premiums that you're paying, and they also are driving the kind of limits that you're buying. A few years ago, carriers were giving out blanket limits. So you might have I worked with the state, it had over $30 billion in values, and they bought a $750 million loss limit because they could. And what happened was once the market hardened, they found out they didn't really need 750 million because we did modeling and we looked at where all their values were, and we found out that they only needed half of that. Or we could get blanket limits for nothing 5 years ago. And now we really need to know, where's your values? How much are they? Are they concentrated together? So if a tornado does come through, what's it going to take out in one fell swoop? And then you turn around and say, okay, so you pay a rate based on $100 worth of values. So if like you mentioned, your values are too high, you're overpaying your premiums. We took over a client and looked at their entire schedule of values. They had been raising their values 4% every year for probably 10 years. And we were able to look at it. It was a community college. So they had a lot of different buildings, but they were very similar buildings. And we were able to take a look at it, and we actually saved them over $600,000 in premium because we got their values to be accurate. And so it's real money, real dollars that you're talking about. And so that, you know, I can't express it more, that as long as you have the right valuations, and we're talking replacement cost value, not for you CPAs on the phone here that are dealing with, depreciation. We need to know what's it going to cost in today's market. And that's why the construction is so important. If you have a concrete building with steel or rebar in it, it's going to be more expensive to replace than a wood frame building. However, a wood frame building is going to burn, that concrete and steel is not. But being able to replace it with, like, you know, in today's market, how much is it going to cost to get the steel from Japan or wherever it's coming from? Having those real numbers is critical. So in the event of a loss, you'll be able to replace that building.
Yeah, and Carlene, you know, obviously here in Texas, you bring up a great point. You're typically looking at replacement costs, but you know, we all know that throughout Texas, there's historic buildings everywhere. A lot of them being on our university campuses, a lot of being in the cities. So you have to look at the historical buildings and say, okay, you know, it's fine to replace the courthouse or the new school at current standards, but if I have a 140-year-old city of Gonzales, you know, historical building, now I've got to look at reproduction value. You know, if a stained glass window in a historic church goes out, it's not just go get another stained glass window from Home Depot. No, we have to recreate that reproduction value. Yeah. So again, it's just having a handle on all of these different things so that you are, again, proactive in the process. If you look at it at a macro level, if everybody was proactive, this is one thing. If everyone in the world was doing the right thing, you would actually change the formula. That would be actually, because then underwriters would have, because, you know, they have to account for all the people who aren't providing all these data and all this. So as a whole society, the more accurate we get in this area, we can actually bring down the formula through competitive pressure. That's just I'm sorry, I went macroeconomic on that, but inefficient markets drive things down.
Yep, that is true. That is true. And so, you know, what can you do today to impact your results and, you know, what's going to happen in the marketplace? You know, losses are inevitable. And are there things you can do to reduce those losses? And, you know, for me, it's about having a plan. You know, understanding, having these conversations early with your risk management partners, whoever they are. You know, ask your broker, ask your agent, how can we improve? You know, what can we do to control it? And, you know, take a look at your program structure. Just because you've been buying, you know, a program for the last 10 years and it looks like this, and these are our carriers, is that the way you should do it going forward? Maybe look at, consider higher retentions, in deductibles, or maybe look at relayering your program. So that way it's playing to different markets and their appetite and having different participants. So if one carrier decides they don't want to write public entity property anymore, you have other carriers who can fill that gap and fill that void. So there's different things that you can do, preparing. And like I said, the messaging is so important. If you've been having flat renewals in the property market for, since 2007, and then your finance guy gets a surprise when your rates have doubled, give them, it'll be a much better message to deliver if you're able to tell them coming into it to expect, huge increases or big increases. And in 2019, we said, well, gosh, maybe 2020 is going to be better and the market's going to correct itself. We don't see that happening. You've got, again, the wildfire season has just started, and it's already significant. We've got something like 50,000 fires that have been burning in 2020 this year. The riot claims, all of the claims around the riots and the civil unrest, right now it's standing to be one of the largest property losses domestically that we've had since 1990s. So those claims were something that weren't really anticipated when you look at typical property and what we can expect. We expect wildfires, we expect hurricanes. We haven't even had a large earthquake in many, many years, and I'm looking for wood to knock on it. So I know.
No.
It is 2020. No, so those are things that you can model and you can predict. So look at what we can do to try and drive that, and what you can do to control that. And, you, like I said, use your resources, talk to your brokers. They're already looking ahead to the future based on what we're seeing. Talk to your carriers. My favorite word is free. So find out what you can get for free from your brokers, what you can get for free from your other vendors and your carriers, because a lot of carriers are offering different services. And so if instead of going out and paying for them, seeing if you can get them from your carrier and include it in your premium. So that's something that you should weigh when you're either looking at a broker or any of your other vendors, whether it's, even appraisal firms. Some offer this awesome software that you get and other ones don't. And so, there's a lot of different things that you can do and get, and it's not just about your bottom line premium either. It's like I said, it's value added in the services that you can get included in that. No comments from you, Doug, for sure. I thought so.
I think in the world of, obviously in appraisals, and you and I have talked about this, there's levels, there's rolled forward spreadsheets to, what they call desktop appraisals, which are done digitally, where they use aerial photography and different things, but that doesn't capture, your roof line is not your building square footage. So if you look at a building, let's take a high school, and you see roof everywhere, well, we all know roofs overhang. So right off the bat, I've got additional square footage that is not actually the building. I can't differentiate breezeways from buildings. So, you get less data. You're not capturing the quality of the roof, the framing, the geometry, the attachments. So you lose that. And then you go to, of course there's different options like anything, but the investment you make to get that accuracy, like we talked about earlier, we've got the technology now doing roof ratings, flood determinations. The more of those columns you fill out in the spreadsheet, and there is, clearly an investment on that side, but it comes back to you in the underwriting and the premium increases and all those other things. So it's got an ROI that is immediate. And so in that case, Carlene, we've got, we do have cases where we've even seen brokers and carriers who put it into their premiums, who've said, look, we understand things are tight, so we're going to actually have you go out and do this as an extension of their business or their practice, because, there's all sorts of machinations of ways to work together. And that's why, again, I think it's a team approach that everyone's got to be willing to come back to. So there are these layers of ways to approach it, but I'm a believer that, if the thing that you can impact is the thing you should impact. And so if it's data and it's loss prevention and loss controls, those should be on the agenda, because That's how we save people and public entities money. And that's going to be critical to your point, revenues. There's only way, public entities can only get sales tax, property tax, franchise, or income tax, right? There's only so many ways of income streams. And when those things are slowed down, we've got to become much more proactive in the way we manage their pieces. And, like anything in life, you get what you pay for. So if you want to be a proactive, sorry.
That's my favorite saying. This after free is you get what you pay for.
You got to be proactive in it and be an active participant versus allowing it to just kind of be what it will be. So that's my.
And technology is your friend.
Yeah.
The 20 years ago, I had a client that had, when I got their property values, it was 3 numbers: real property, personal property, total. That was what I got. And, and it was a really large county. And, and like you said, there was over 900 locations once we started drilling into it. And, being able to look at it from a geocoding standpoint and be able to, put the pin where they are, and are they really in a flood zone? Maybe, maybe not, and be able to look at it. Technology is definitely your friend. So
I think sometimes as a general public, we forget about these large public entities operating in the background, kind of making things happen for us on a daily basis. And sometimes these public entities themselves don't realize how large of an operation they are. They rival, some Fortune 500 companies. When you talk about the county you just mentioned, how little information they initially would give you, and they had 900 locations. I mean, that'd be a huge publicly traded company if you thought about it. Forbes recently released a list of, the 100 top employers in Texas, and there was many public entities on the list. Number 2 was KDISD, and they were number 2 to HEB. So number 1 was HEB. If you're coming in right behind them, that's something to be very proud of. But there were several other public entities on this list named by Forbes, and I like when those lists come out because it kind of puts that front of mind. The governmental entities in our communities and our regions and the state are extremely important. And so all the topics you covered today on risk management and what they can do to kind of help manage risk, especially the data part of it, of having accurate data, updating the spreadsheet, getting valuations done, kind of getting a good handle on what exactly you have and what condition it's in, how it was constructed, what it's constructed of, and the age of all your property is very important. So
definitely. No, and I'll just add, Lupe, you always have a great analogy that these school districts, just as an example, run the largest restaurant chains in town. And mentioning Katy again, they serve 84,000 kids twice a day at least, right? Not including any after school meals. And you add Fort Bend ISD, Houston ISD, Dallas ISD, and when you aggregate the number of students that they're serving plus the employees that they employ, I mean, the numbers are great. And so we get our public safety, our utilities, running the largest restaurant chains if you're a school district. So it's very important. And so when these governments have losses, they're going to have to fund the losses if insurance is not there to help them recover that. And where does it come from? Out of their general fund monies, and that goes straight to the bottom line, and it hurts their opportunity to continue to serve the public, to serve the students. So aside from any FEMA, which is difficult to come by if not all the requirements are met. So insurance is critical in these instances.
Right. It's kind of funny because you kind of mentioned that it's a very circle of life thing, right? Because you have riots or something that causes a loss, and it's caused by people who live there, and then they complain about the taxes, but the taxes are what now have to pay for the loss because or maybe there's it just is a big circle. California is seeing really large jury verdicts, and I mean they're crazy jury verdicts, like $50 million in punitive damages. And where do school districts or public entities get the money to pay these jury verdicts? They're not getting insurance for all of that. It's coming out of the tax base. And so it is a crazy thing to think about.
No, and I think they have to put it in perspective. You bring these budgeted line items, such as the insurance premiums, and it may be a large number for that fiscal year, but you need to take into account what happens in the future. What losses are we facing in the future if we don't pay these premiums now? So I think they need to put that in perspective instead of just worrying about this year's budget and how can we cut cost. It affects everything in the future, and I think we need to not be so short-sighted when it comes to that, because it is affecting many public entities.
Absolutely.
Well, the next portion of our podcast is Fun Fast Facts. So to give the listeners a little bit of insight into your personal lives, what makes Doug and Carlene tick, we're going to ask you a few questions to see. So Carlene, what was your first car?
Plymouth Satellite, and everybody called it the Dish. And it could fit a bunch of people, so.
I like that, the Dish. What about you, Doug?
My parents bought me the most beautiful 1986 CJ7 Laredo Jeep, and it was the most beautiful car I had for 30 days. And then after I flipped it, they bought me a 1980 Buick Skylark.
Oh, man.
Do you remember how that claim was processed?
Yeah. Actually, if you really want, now this could be the wah wah. My parents actually got thrown into the state pool for insurance after that. I did
bad.
Insurance pool for 2 years.
Oh, no.
They were not happy. That was not a fun story.
Okay.
It is 30 years later.
Yes.
Have you flipped any cars since then?
No, not at all.
Okay. What about a book you're currently reading, or current Netflix show you're streaming, Doug?
So I am actually reading, it's actually a really great book. It's by a guy named Christopher Voss. It's called Never Split the Difference. And he was a 20-year top FBI negotiator. And, the title of the book makes you think it's about like how to manipulate something, but that's not what it really is. It's the fact that a negotiator can't split the difference. They can't say you have 4 hostages. Okay, 2's good enough. Give me 2 and we'll split the difference. It's all about human nature and the way people think and how to talk to people and how they respond to things, because he never had the option to negotiate. He had to win or nothing. So it's a good
That
book.
is way too above me, because I'm rereading The Girl with the Dragon Tattoo series for the 3rd time. So I did way more reading before Netflix came out, though. So, when you say what's my current Netflix binge watching, I'm like, gosh, I've made it through, I don't know how many political dramas, enough where I forget whether what I'm thinking about from a political standpoint is real life, or whether it came from Madam Secretary or the West Wing, or getting them confused. So.
Yeah. Well, if there's any year to watch political dramas, 2020 is it, especially with what's coming up here in a few months.
Yeah.
It is, right.
Carlene, what was your first job?
My first paid job? No, my first job was picking rocks for my dad. And we knew we'd come home and get off the bus and you'd see that particular tractor and that particular wagon, and we'd say, oh no, we have to go pick rock. And he'd pay us $5 an hour.
Oh.
How about you, Doug?
So my parents knew the owner of a copy shop, and if you guys ever get those Val packs in the mail with all those coupons, I got a job when I was 6 years old, collating and putting, they all have to be printed separately. So I would sit there and collate and pack the Val packs, or whatever the equivalent was back in the 70s. And then eventually someone complained that it was child labor. And so I was so proud of that job. I was making money, and then someone turned it in or threatened to turn it in, and I lost my job a month later. I loved it.
I might have to sue my parents for that whole child labor thing.
So not only are you the youngest person in America named Doug, you were also the
correct.
youngest person to pay Medicare and Social Security tax and federal income tax.
Yes, I definitely filed my taxes. I know you get
At 6 years old.
They sent me a 1099. No. It was the 70s, Lupe.
Carlene and Doug, thank you both for your insight and the great information you provided on today's episode. I think our listeners really learned a lot, and they'll know how to contact each of you at the end of this. That wraps up this episode of Major Fundcast. Everyone stay tuned for our next episode that'll come out here shortly. Everyone have a great day. See y'all next time. Bye.